Atlanta Electricals Limited Q4 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chaitanya Satve. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to Atlanta Electricals Limited's Q4 and full year FY26 earnings conference call. Joining us today are Mr. Neeral Kupesh Bhai Patel, Chairman and Managing Director, Mr. Akshay Kumar Mathur, CEO, Mr. Mehul Mehta, CFO, and Mr. Anand Sharma, the Chief Operating Officer. Before we begin, I would like to remind participants that certain statements made during this call may be forward-looking in nature and are subject to risks, uncertainties, and assumptions. These should not be relied upon as guarantees of future performance. I now invite Mr. Mehul Mehta, our Chief Financial Officer, to take you through the financial highlights for FY26.
Thank you, Chaitanya. Good morning, everyone. FY26 has been a defining year for Atlanta Electricals, and I'm pleased to walk you through the financial performance of the year and the fourth quarter. I shall start with sharing financial performance for full year FY26 and Q4 FY26. Straight away zooming into fourth quarter, revenue from operations for Q4 FY26 stood at rupees 747.6 crores, a robust growth of 81.7% year-on-year from rupees 111.5 crores in Q4 FY25 and subsequently higher by 58.5% over Q3 FY26. EBITDA for the quarter stood at rupees 149.6 crores, more than doubling year-on-year with a growth of 117.9%, while EBITDA margins expanded to 19.99%, effectively touching the 20% mark compared to 16.7% in Q4 FY25. Profit after tax for Q4 FY26 stood at 102.2 crores, up 128.9% year-on-year from 44.7 crores in Q4 FY25. On a consolidated basis, revenue from operations for FY26 stood at rupees 1,851.5 crores, representing a strong growth of 48.8% year-on-year from rupees 1,244 crores in FY25, comfortably ahead of the 40% growth trajectory targeted we had set for the year. EBITDA for full year FY26 stood at rupees 344.4 crores, up 77.9% year-on-year, with EBITDA margin expanding to 18.6% compared to 15.6% in FY25, reflecting an expansion of 300 basis points. Profit after tax for FY26 stood at rupees 201.8 crores, registering a healthy growth of 70.1% year-on-year. This margin expansion is structural in nature, driven by operating leverage from higher volumes, a richer product mix tilting towards 220 kV class, which now constitutes nearly 52% of our revenue, and improved procurement efficiency on key input materials. As targeted, all long-term debts fully repaid, I'm pleased to confirm that we have delivered fully on the debt reduction commitment made during Q3 FY26. We had availed 130 crores of term debt for our Vadod plant and 210 crores towards the BTW acquisition, a combined term loan liability of rupees 340 crores. As of 31st March 26, the closing balance on all term loans is nil. This has been completely repaid through a combination of IPO proceeds, internal accruals, and general corporate purpose fund, ahead of the original repayment schedule. This meaningfully reduces our finance cost base going forward. Moving on, I shall take a while to speak about cash flow position. Our operating cash flow for FY26 is healthy at rupees 184 crores, reflective of the strong underlying business momentum and disciplined working capital management. Our credit profile continues to strengthen. CRISIL reaffirms our long-term rating at A stable and short-term rating at A1, and our overall bank facilities have been enhanced from 910 crores to 1320 crores during the year, which predominantly covers non-fund based requirements, providing us ample headroom to support our growth trajectory. On the year-end inventory position, I would like to confirm that it was a planned decision. You will note that our year-end inventory is slightly lower than what one might expect at this scale of operations. I want to be clear, this is by design and not a reflection of any execution slowdown. We had proactively planned preventive maintenance shutdowns at two of our facilities for early April, and inventory was deliberately drawn down in March end to facilitate those maintenance windows smoothly. This is a considered operational call that demonstrates the maturity of our planning processes. All ongoing capex are funded through internal accruals. Our ongoing capex programs, including the new inverter duty transformer facility and the tank and radiator backward integration initiatives, are presently being funded comfortably through internal accruals. As an enabling and prudent step, the board has already approved a term loan facility that may be drawn down at a later stage if required. However, as of today, our cash generation is sufficient to support the full capex roadmap without any external borrowing. Utilization of IPO process. Turning to IPO fund utilization, out of the 400 crore fresh issue, approximately 395.46 crores has been deployed as of 31st March 2026. The deployment is as follows: rupees 79.12 crores towards repayment of borrowed term loan, rupees 210 crores towards working capital requirements, and rupees 85 crores towards repayment of the BTW acquisition term loan under general corporate purposes, and rupees 21.31 crores towards public issue expenses. The balance of approximately 4.54 crores lies in our public money account against remaining offer expenses yet to be claimed. There has been no deviation from the objects stated in the offer document, and this is being validated quarterly by our monitoring agency. With that, I hand over to Mr. Anand Sharma, our COO, for the operational update.
Thank you, Mohan, for sharing valuable insights into the organization's remarkable financial performance. And good morning, everyone. I would now like to take this opportunity to walk you through the operational performance of financial year 26. I shall start with an update on the total MVA produced in FY26. Across all 5 manufacturing units, a team of Atlanta Electricals produced a total of 22,943 MVAs in financial year 26. This is a significant step up in output and reflects the full benefit of our expanded capacities coming to life. During this year, we started getting contribution from our Vadod and Anki facilities. Our new Vadod facility, which we call it as Unit 4, contributed 6,960 MVAs of production in approximately 7 months of operation since commencing production in July 25. Our Atlanta Trafo facility, which we call it Unit 5 at Anki, contributed a production of 580 MVA in approximately 3 months of production during Q3 of FY26. It's worth highlighting that our 3 legacy manufacturing units located in Anand and Bengaluru continue to run at very high utilization ratios through the year, reaffirming exactly why the new capacity investment at Vadod and Atlanta Trafo was both timely and necessary. Our efforts to ramp up Unit 4 with proactive preparation was instrumental in delivering results. The Vadod story is the one which we are particularly proud of. The intensive preparatory work done over the 12 months preceding commissioning, with engineering teams aligned and trained labor pre-inducted, machines commissioned ahead of schedule, and crucially, orders pre-lined up to feed the facility from day one, has paid up in full. Orders were secured and structured in advance, specifically to ensure there was no idle time at Unit 4 commissioning. This forward planning directly enabled meaningful utilization right from the day one. In each of the last 3 months of FY26, we consistently dispatch approximately 15 transformers per month from our Vadod unit alone. an output level that speaks directly to the ramp-up quality at the plant. On an annual basis, for the 7 months of operation, Unit 4 operated at approximately 39% of the nameplate capacity, which is 30,000 MVA. Our speed at the end was affected for last couple of months due to the shortage of mineral oil. Despite the temporary shortage of mineral oil during Q4 of FY26 arising from the ongoing West Asian conflict, we were able to maintain a strong production and dispatch momentum due to our proactive forward planning, inventory management, and ability to shift part of the manufacturing towards green transformers using alternative ester oils. We received PGCIL approval, which was, according to us, was the fastest in the industry. The single biggest operation milestone in the FY26 is the PGCIL approval for the manufacturing of transformers up to 400 kV at our Unit 4, which is Vadod facility. We received this approval on 2nd April 2026. This was achieved within just 2 years of groundbreaking at Vadod, and to the best of our knowledge, this is among the fastest construction to PGCIL approval timelines in the Indian transformer industry. We call this as Atlanta speed. This approval is subject to completion of short circuit test and final qualifying requirements, which will be completed in due course. We also received or secured our first 400 kV order during FY26. Additionally, we have quoted at multiple PSUs for their tenders, but now we are deliberately participating in restricted quantities. Our approach is straightforward. Manufacture and prove the first prototype, validate it fully, and only then open the doors to additional 400 kV orders. This prototype first discipline will help us enter the EHV market with higher degree of confidence. With this, I now invite our CEO, Mr. A.K. Mathur, for his remarks. Mathur sir.
Thank you, Anand, and good morning, everyone. I hope I am audible. I'll share 3 strategic reflections on what FY26 meant for Atlanta Electricals. Number 1, during FY26, growth was driven by new capacity and market tailwinds. FY26 growth has been the result of 2 mutually reinforcing forces: the operational contribution of our new manufacturing units, Unit 4 at Vadod and Unit 5 at Atlanta Trafo, coming online at right time, and a highly supportive market environment where domestic demand for transformers, especially for higher kV class, has remained robust and structurally sound. When new capacity and market conditions come together in the right way, the results speak for themselves. 48.8% revenue growth and 77.3% EBITDA growth in FY26 is testament for exactly that. Having the strength of added capacity, we started approaching new customers and markets with better confidence, which provided a strong order book and thus providing revenue visibility. Team Atlanta booked 2,507 crores of new order during FY26, which elevated our unexecuted order book on 31st March 2026 to 2,493 crores, providing a strong execution visibility going into FY27. Importantly, the quality of the order books continues to improve with a higher contribution from 220 and EHV plus transformers, reflecting our gradual movement towards higher value and technologically advanced products. We believe this positions us well for sustained growth over the coming years. Point number 2, we say it with pride that our investment payback is unprecedented in the industry. One of the most compelling narratives of FY26, the speed of payback on our approximately 200 crore investment in the Vadod facility. Industry convention for a transformer facility of this scale and voltage class typically projects a payback period of 5 to 7 years. Vadod alone contributed nearly 495 crores of revenue in first 7 months of operation. Based on this trajectory, we are well on the course to achieve payback in 3 to 4 years' time, which is the best to our knowledge, is largely unheard of in the transformer manufacturing industry. It is important to speak about our new product development plan, that is 400 kV and 765 kV. Our new product development roadmap is phased and disciplined. At Vadod, the focus is firmly on 400 kV class prototype. At Atlanta Trafo, our Anki plant is focused on 765 kV class prototype. The pathway is clear: prototype, validate, and then scale. This disciplined sequencing is how we will build a credible EHV reference and base that will unlock a significantly large order pipeline over next 12 to 18 months. Our green transformers were instrumental in converting a constraint into a strategic advantage. The mineral oil shortage in Q4 FY26, triggered by the West Asian crisis, would have posed a much more severe challenge for our deliveries. However, because we had already secured order for green transformer, which uses natural and synthetic ester oils as an alternative to conventional mineral oils, we were in a position to prioritize green transformers production during the period of mineral oil scarcity. This flexibility shielded our deliveries and demonstrated the resilience and versatility of our product portfolio. Going forward, we expect green transformer to grow as a category as customers increasingly prioritizing supply chain resilience and ESG consideration in their procurement decision. Thank you very much. With this, now I request our Chairman and Managing Director, Shri Neeral Patel, for his closing remarks.
Thank you, Mathur Sahab, and good morning, everyone. Though we are firing on all cylinders, there are priorities. Let me close with our priorities and vision for FY27. Prototyping 400 and 765 kV are our top priorities. Our single most important focus for FY27 is successfully prototyping of 400 kV class transformer at Vadod and 765 kV class transformer at Anki facility. These prototypes are not just engineering milestones, they are gateways to significantly larger addressable market. Once delivered and validated, they will allow us to scale our EHV order books in a meaningful way. EHV orders carry execution lead times of 18 to 24 months, and pipeline sizes are substantially larger than the lower kV segments. We are building towards that future, one prototype at a time. Aggressive push in the export market is the next priority. We will be putting significant and focused efforts in exploring export markets aggressively in FY27. The first sizable export order is received in FY26, which has given us a strong foundation to build upon. We shall now be pursuing other markets in a systematic way. We shall choose markets with an intent of staying long in those territories. We are in a process of identifying right markets for us, and thereafter we shall have our physical presence in select markets to move more decisively. Domestic demands, multiple new emerging verticals are already coming up. On domestic front, we see transformer requirements scaling up sharply across three new verticals. First, battery energy storage systems, BESS as how we call it, as India's energy storage build-out accelerates as to balance the intermediate renewable generation. Second, data centers, which are rapidly growing with rising digital infrastructure investment and AI-driven compute demand. Third, the renewable power generation. Solar and wind projects has continued to require large number of transformers for evacuation infrastructure. These verticals add meaningful diversification and durability to our domestic demand order outlook. Commencing Unit 6, the inverter duty transformer facility, we will commence operations at Unit 6, our dedicated IDT transformer facility during FY27. We are working towards making this facility operational before end of this calendar year. Once commissioned, we shall add about 5,000 MVA for production of IDTs. IDTs are a critical component in renewable energy projects, EV charging infrastructure, and this facility will position us to address what we believe will be the fastest growing segment of the transformer demand in India. tank and radiator manufacturing facility for backward integration. We will also commence tank and radiator manufacturing plants during FY27. This backward integration initiative will give us tighter control on supply chain, improved quality for export markets, consistency, and meaningful cost benefits over time, all of which will contribute to further strengthening our margins and delivering reliably. In order to have better operational control, we shall set up this facility in close proximity of our Vadod facility. Closing remarks. FY26 has validated our investment thesis in every measurable way. 49% revenue growth, nearly 300 basis points improvement of EBITDA margin expansion, complete repayment of all term debts, the PGCL approval at Vadod facility at the first 400 kV order in our history. The platform we have built is strong. The next chapter is about converting EHV approvals into EHV orders, scaling exports, and operationalizing Unit 6 and our backward integration plans. Within a short span, we shall also be commencing procurement procedure of merging a Trafo with Atlanta Electricals Limited. We remain deeply committed to creating sustainable long-term value for our stakeholders. We thank you for your continued trust and support in Atlanta Electricals. We now open floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and then one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and one to ask a question. We will take the first question from the line of Kunal Mehta from InCred Equities. Please go ahead.
Yeah, hi. So very good morning, and congrats on the amazing set of numbers and a very detailed guidance across operations, finance, and strategic view. However, I have 2 or 3 questions. The first is, the margins, the gross margins and the EBITDA have improved about 350 bits on the gross and 300 bits on the EBITDA level. So do we see this as a steady state margin, now that our mix is, bent more towards the extra high voltage transformers? So do we see this as, something that we can have built in going ahead?
Good morning, sir. Thank you for your wishes. And we see these margins, relatively stable. When it comes to 220 kV class and below manufacturing, the improvement in margins is because of incremental production, the scale-up that happened in the 220 kV segment, and that's where the capex was. But going forward, we see the margins being stable for times to come.
Okay. And our average realization has risen above almost 8 lakh per MVA. So, and I think in the previous call, I think Neeraj sir had mentioned that, with increasing, moving more towards extra high voltage, the per MVA realization will come down. So I just want to understand this, how is the realization going from 7 to 8 lakh now? Is it because of, is there some kind of price hike that we are taking or?
The revenue per MVA is directly related to the commodity pricing, and commodity pricing is clearly naturally hedged to the customer orders itself. So if the commodity pricing goes up, I'm talking about steel, copper, oil, etc., the prices per MVA will relatively also go up. Per MVA pricing will naturally not be a factor to highlight how the industry is performing. It is directly linked to the commodity pricing. To answer your question, yes, we will be seeing per MVA realizations getting dropped in coming times. because more the MVA per unit, per MVA realizations drop. We are in the process of prototyping 400 and 765, which are typically 500 MVA products, which are higher than what we are making right now, typically 160 and 200 MVAs. So per MVA realization will drop.
Okay, sir. Sir, I think 400 kV, we are, I think, almost through. I think in second quarter, when we receive the approval, on the product level as well, we can start, aggressively pitching for order. But what about 765? And, what are certain timelines? If you can throw some light on that.
We've started marketing our 765 kV class products. We've not received any breakthrough yet, but yes, the intention is to prototype it first. This year, we would be spending a huge amount of time to prototype 765 kV class transformer and reactor, and then, of course, entering in the market. Any orders that we are able to take or grab in this particular year will fall for invoicing in next particular, considering the lead times that are there in the Indian market.
Okay, sir. And so just one last question on the tank and reader CapEx. I think you mentioned about 180 crore of CapEx. And I think Mehul also mentioned that we will be doing through internal accrual. So we have a bank balance of 93 crores and a healthy cash generation. So any possibility that we'll be drawing down the 50 crore term loan line? And what are the timelines also for CapEx to get live?
This financial year is when we are trying to commence this tank and radiator manufacturing facility. It's a completely robotic investment that we are doing so that we can achieve good quality of automation and quality control. Yes, the cash flow position of the company looks significantly healthy. However, just not to affect the project timeline, we would be taking a term loan if required, and we would have the intention to completely pay it off in the coming financial year, if taken.
Will it be more towards the end of it? Will we see any benefit in this year, or will it go fall to the next year?
The benefits would be coming in next year for sure.
Okay. Thank you so much, sir. I'll call back in the queue.
Thank you.
Thank you. Before we take the next question, ladies and gentlemen, in order to ensure that the management should be able to address all the questions from the participants in the question queue, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We will take the next question from the line of Tina from Motilal Oswal Financial Services. Please go ahead.
Hey, sir. Congratulations for a good set of numbers. My question is regarding the raw material side. So which are the areas among the categories of raw materials where you can easily manage the supply chain and are likely to see a normal procurement, and which are the areas and which are the components where you can see some pressure or delay or any kind of higher costing, which can be felt, let's say, in next 1 to 2 quarters because of the way things are going on globally. So this is just to get an idea as to how we see the margins going forward, both in terms of overall pricing and overall the cost side.
Hi, Tina. Good morning. Anand Sharma this side. I'll take this question of yours. First of all, the troubles which industry has been facing, so I'll reply on that. Historically, we have seen that industry has been facing supply crunch on the conductor side, bushing side, and the fabricated component side. We have been telling for last couple of calls that the situation around the supply of conductors is improving because many of the manufacturers, Indian manufacturers who had announced their plans to expand capacities, those expanded facilities came to life, and we have started now taking the supplies. And there are new manufacturers also who are getting into this game, and the supply side of the copper conductor is certainly going to improve. While there is an improvement on the conductor side supply, and the situation around RIP bushing also is going to ease out in a time to come, because there are going to be facility expansions coming in from the existing players in India. we are seeing in particular the supply issues on the OIP bushings, for which also we are trying to find, let's say, solutions by the way of booking orders in advance, by the way of coordinating with our suppliers well, and trying to find out new vendors. As far as the pricing is concerned, of course, there are multiple factors. So commodity prices, right from copper to aluminum to crude oil, everything is going up. And this particular thing of West Asian disturbance is not only affecting the oil prices, this crude prices is indirectly affecting other smaller component pricing also. May it be fabricated component pricing or the paint prices or the gasket prices. So those small components also we are going to see some kind of price hike. But we believe that this particular thing is temporary in phase. Once we have the resolution on this ongoing crisis, these things should cool down in a time to come.
So the cost increase that you are seeing on account of all these smaller components and smaller items which are seeing a price hike, are you able to pass on this cost increase also to the end users for your existing contracts which are there in your 220 kV category?
Tina, we are able to, since the majority of our contracts are on with the price variation formula, we are able to pass on the majority cost to our customers. These smaller components which I told you, like components like gaskets and paints, etc., these are very, very, very minimal raw material contained items for any transformer manufacturing company. So it will not have any major impact actually.
Understood. And another thing is on the tech tie-up for the 765 kV transformer. So where are we in terms of the stages of achieving this?
We are in discussion with a couple of agencies, name of which surely cannot be disclosed at this point in time. But we are in discussion with a couple of agencies or companies to finalize this particular tech tie-up for 765 kV. We are expecting it to be closed in next couple of months. That's the target we have kept for ourselves.
Understood, sir. And the short circuit test would be due sometime in the month of June, July for your 400 kV?
I would not be committal on that front. Yes, we are working, and yes, in coming quarter we shall certainly be sending our transformer for the short circuit.
Understood, sir. Thank you. That's all from my side.
Yeah.
Thank you. We will take the next question from the line of Anuj Shah from Phillip Capital. Please go ahead.
Good morning, everyone. Kudos to the entire team of Atlanta Electricals for delivering another stellar set of numbers. So I had just a couple of questions. Firstly, could management provide some sort of perspective on the expected utilization ramp-up of Vadod facility over the next 12 to 24 months and potential revenue contribution from higher KV segment?
The expected utilization of Vadod facility is on track. We expect it to be, like we suggested before going public, about 35% in the last financial year, which is about 39%. We expect it to be 65% in this particular year, and then eventually taking it to 100% in the next financial year. 65% is because of the development time that is going to take into 400 kV class and the production of 400 kV, mainstream production of 400 kV class coming in next financial year would ramp up the capacity to 30,000 MVA. As of today and in this financial year, majority of the products that would get manufactured would be still 220 kV, and only some products of 400 kV.
Okay. My second question was, so as we now continue to scale our operations and move towards a higher value product mix, do we see any further scope for margin expansion, or we stay very conservative in terms of margin guidance and maintain that 18 to 20% band for next financial year?
Historically, we've been maintaining one stand that we would be growing at about 40% CAGR for next 3 years. First year has already passed by with an intention of margins being stable. because of the system, because of the reason that we have yet not manufactured a 400 kV class transformer and the 765 kV class transformer under the brand name of Atlanta Electricals. However, when we start manufacturing, we would be in a better position to tell you any improvement in the margins are there or not. But as of today, we maintain a stand that it's going to be stable.
Okay, thank you so much and all the best to the entire team. Thank you.
Thank you, sir. Thank you.
Thank you. We will take the next question from the line of Arafat Sayyed from Dolat Capital. Please go ahead.
Yeah, hi, sir. I'm audible?
Hi, good morning.
Good morning, sir. How are you?
Good, sir.
Yeah, so congrats on a very strong quarter and also excellent FY26 performance. So most of the question has been answered, but just to, let's say, if you are becoming a debt-free now, so how does the management plan to utilize future cash flow, let's say higher capex or working capital or let's say any other form of acquisition kind of thing?
So Arafat ji, Mehul this side. Naturally speaking, as we move up higher KV class execution, requirement of working capital will be there. It will increase for sure. That's the reason we were commenting every time that going forward in FY27 and FY28, our net working capital days will go up around 80s and 90s. However, during FY26, we could maintain our net cash flow days at around 64, and going forward, it will increase for sure.
Sure, sir. And the next one, can you please comment on the competitive landscape in the transformer industry, especially the multiple player announcing fresh capex across the category. So how do you see that?
Arafat sir, Anand Sharma this side. This is a very, let's say, obvious question which comes every time we get into a call with any of the, let's say, investor fraternity. So the capacity expansion which is coming or has come up or shall be coming, we have been maintaining that it is because of the demand generation, and it's to meet the demand generation when it comes to the transformer requirement. India has been setting up newer and newer targets and higher targets for the power generation. So we have been hearing 500 gigawatts by 2030. The new target which I have been in particular listening for last 15 days is 900 gigawatts by 2035. This coupled with the requirement of transformer coming in from the Europe, the USA market, Middle East, I'm sure that whatever amount of capacity Indian manufacturers are going to put up, it is going to still fall short of the requirement. The requirement is going to edge over the supply side for at least next 5 years for sure.
Got it. So lastly, let's say any plan to, let's say, starting export to other countries, and what's the future look like for a company like yours? And what are targets for you to generate for export?
Arafat sir, we have been maintaining this trend that in next 3 years' time, we have this target of taking our exports to 15% of the total revenue. We are working towards developing those markets. We have started discussions in different markets with different set of customers. It would not be fair on our part to maybe commit or comment as to which markets we are approaching and what is the progress on that. But yes, wherever, as Neeral sir also suggested on the call, that wherever we shall be putting our foot, we shall be doing it with an intention that we are going to stay there for a longer duration. And it's not going to be a transactional business for sure.
Got it, sir. Thanks. That's it from my side.
Thank you, Professor.
Thank you. We will take the next question from the line of Nikhil Chaudhary from Toro Wealth Managers LLP. Please go ahead.
Yeah, congratulations team on a very stupendous performance. And I had just two questions. In Q3, we've been, like we mentioned that we've been quoting on data center inquiries. So just wanted to get a reconfirmation on how many active inquiries and what is the conversion timeline. Because one of our peer has actually received very large orders. So just trying to understand if this is a very strategic priority for us, or along with other export opportunities too? Second question is, if you are comfortable, what would be the gross margin delta between 400 kV and 220 kV in your current assumptions?
So, sir, export markets do end up taking a lot of time to for the orders to get finalized. They come in with long-term planning, and they do have time to, shortlist the vendors. So when we say we are working on it, we expect to have a breakthrough in this financial year in terms of orders. But the execution will definitely fall on the next year because the lead times are much larger than what we have in the Indian market for even 220 kV and below products. Responding to the margins margins or value addition of 400 kV class, we say that, we expect that 400 and 765 kV class would be at around 200 basis points higher. But as of today, in the current last financial year numbers, there are no 400 kV class products, and there are no revenues coming in for 400 kV class products.
Yeah, got it. Thank you so much, and wish you all the best.
Thank you.
Thank you. We will take the next question from the line of Naman Parmar from Niveshaay Investments. Please go ahead.
Yeah, good morning, sir. Thank you so much for the opportunity and congrats on great set of numbers. So firstly, I wanted to understand on the current order book, how much contract would be the fixed contract and how much would be the price variation cross contracts?
Yeah. Hi, Naman. So current order book which we have, and we maintain this trend throughout the Concalls, that we are maintaining around 70 to 80% of the orders from the state utility boards. So this ratio is in the range of, let's say, 60% to 75% in recent times. And going forward also, we expect that this ratio to be there. At the outset, we would like to say that any orders from state utility boards is backed by the price variation clause. And in recent times, even the private orders, which are for longer horizon, are also backed by the price variation clause.
Okay, yeah, understood. Thank you so much. And secondly, on the 180 crore capex that you have told about the radiator and tank facility and IDT division. So IDT 5000 MVA would be totally a new capacity, which will be live in the another greenfield plant, or it will be in the existing plant only?
So IDT facility will be in the existing Vadod facility only. So it is the adjacent area of Vadod facility. And that is the additional capacity of 5000 MVA.
And how much will be the capex? Yeah, so 180 crore capex, then what will be for the IDT and what will be for the radiator and tank?
So for IDT, it is around 65 crores of capex. And for backward integration, it is 170 to 180 crores of the capex.
Okay, understood. And lastly, on the currently, like how the whole industry is moving towards lots of long transmission line like HVDCs and all. So there will be big requirement for the HVDC converter transformers. So any update that we will be entering that particular market in coming future, like we are entering the 400 to 765. And if we see a very big potential on that side, then we are thinking to enter that market.
Sir, there is a good demand on the HVDC transformer requirement. That is for sure is there actually. But for a company like us, which is concentrating now on the development of 400 and 765 kV products, it would be too early and ambitious to say that we possibly would start working on HVDC in a time to come. We would focus more on establishing or doing the prototype for 400 and 765 kV first. And once we have done that successfully, we shall certainly be trying to find newer growth territories and it surely would be HVDC. But there is no point we commenting on it at the moment.
Right. Yeah, understood. Thank you so much. Yeah.
Thank you. We will take the next question from the line of Sukrit D. Patel from Eyesight Fintrade Private Limited. Please go ahead.
Good morning to the team. I have two questions. My first question to Mr. Niral Patel is, in your point of view, how is Atlanta Electrics preparing to capture evolving demand in electrical equipment and power systems while thoroughly addressing challenges such as raw material volatility, technological shifts, and competitive pressures? And what strategic levers do you see important that will differentiate from your peers in the coming quarters? That's my first question. I'll ask my second question after this. Thank you.
It's a very detailed question, and it's going to be a long answer, but I'll be fairly brief as I can. When it comes to differentiating Atlanta Electricals, we are a company who is very lean in terms of our fixed costs, and we intend to be that, and we intend to keep it in the longer duration. When it comes to planning, we are always a step ahead. When it comes to technological development, we are again a step ahead. We would like to be part of the growth story that is coming in for the transformer space requirement, hence coming power demand, which is going to eventually create demand for transformers. To sustain that growth story, we've already taken up developments of newer technology products that are 400 and 765 kV class transformers and 400 and 765 kV class reactors, which will play a big role in the growth story of Atlanta Electricals.
The second question to Mr. Mehul Mehta is, as the company continues to benefit from infrastructure and industrial demands, how are you prioritizing capital allocation between capacity expansion, technological investments, and shareholder returns? And what long-term cost efficiencies are being put into place to safeguard margins amid rising input and compliance costs? Thank you.
So, sir, right now the focus is on development of 400 and 765 kV. So we are allocating fixed capital over there for newly built capex plan for IDT as well as the backward integration. These are the two capex which will be coming in this financial year. Other than that, there will be cost related to development of 400 and 765 kV, which is in terms of, let's say, short circuit test, as well as technical tie-up for 765 kV. So we are allocating a good amount of capital over these two plans. Along with this, as I told earlier, there is increase in working capital requirement as well. So we are focusing on that as well.
Thank you and best wishes.
Yeah, thank you. Thank you.
Thank you. We will take the next question from the line of Parakshit Khandpal from HDFC Securities. Please go ahead.
Yeah, hi sir. Congratulations on a great quarter. So first question is on data centers. So what is the total share of order book from the data centers, and how do you think this opportunity will play out over the next few years for us?
Sir, as of now, good morning. Anand Sharma this side. As of now, there is no portion of data center business in our kitty. We are in discussion with different customers, potential customers, to explore this particular market. But yes, to confirm, as on date, there is no single order of related to data centers in our kitty.
Then how big this opportunity could be? Any assessment on this opportunity, both on the Indian context and even export markets for us?
It is looking to be huge. We do not have any fixed numbers or specific numbers to tell you at this moment. We are also exploring different opportunities, and if different reports give different numbers, so it's not fair on our part to just pick one particular number and put it on the table. But this looks to be pretty interesting a case, and it's going to be quite sustainable a demand in a time to come.
Okay. The second question is on the commodities. So what portion of our raw material is imported, and weren't we impacted by the rupee depreciation? Some of our peers have seen the margins cracking because of commodity or then transformer oil, then copper prices going up. So what was the hit for us? How do we hedge copper? So if you can highlight some of these things now, how you are mitigating the impact of the commodity price increases and rupee depreciation.
So our organization's strength has been that we are having a majority of our orders with the price variation clause. So that has been the strength of the organization, and that's one particular strength which is coming quite handy and these kind of difficult scenarios which are prevailing at this moment. So whatever price increase we are seeing in the commodities, different commodities, we are able to pass it through to the customers with the help of the price variation clause which we have coming with the purchase order. What we have also started doing of late, that we have also started talking to the private or the corporate customers to provide orders or to give orders with the price variation clause, so that we are able to mitigate, if any, risk on the private or corporate customers' orders also.
So out of the 2,493 crores order book, is it entirely passed through? So I think earlier you gave some share of the utility, so I didn't quite get it. So is it like only 60 to 75% order book is passed through, or like, so if you can help us understand?
Yes, you are right, sir. You are right. Approximately 75% of the order is with the price variation clause, and rest of the orders are without price variation clause.
So, but in this quarter, can you quantify any hit you would have taken if on account of commodity? So if the margins would have been better if that fixed price portion was also passed
No, nothing. We have not taken any hit in the previous quarter.
Okay. And can it come in Q1 now?
No, we don't expect it to see, and it's quite early for us to comment on that. Okay. As to where prices shall. We have daily movement of the prices nowadays, so it's a different phenomena. So we'll get to know when it comes.
Okay, sure, sir. Thank you, and wish you the best.
Thank you, sir.
Thank you. We will take the next question from the line of Jigar Jani from Nuvama PCG Research. Please go ahead.
Yeah, hi. Thanks for taking my question. Sorry, I'm a bit new to this company, so the questions you might have answered in the previous con calls. But on your backward integration project, what kind of margin accretion are you expecting when this project comes online on the tank and radiators backward integration that you would be doing? That is my first question. And my second question is, given that you are going to utilize Vadod more, so there will be operating leverage coming in, plus the backward integration part. What kind, and plus moving into higher kV transformers, what kind of margin accretion totally do you see once all these three benefits kind of flow through into your P&L? Yeah, so if you could answer that. Thank you.
Sir, very frankly speaking, backward integration for radiators and tanks is not because of margin improvement. That's not the intention of the company. The company's intention is to align its supply chain management, because we all know that all of transformer manufacturers are expanding. Requirement of radiators and tanks is going to further expand, and we need to allocate our own supply chain for that. That is point number one. Point number two is it is because of quality improvement.
This order. Yeah, sorry. Go on.
Point number two is because of quality improvement. When we are targeting export markets, it is always better to have good robotically engineered radiators and tank fabrication and robotically painted. So that is the reason this capex has been put in place. When we talk about 400 kV development, 765 kV development, there is going to be expense that is going to be attached to the technical tie-up that we are going to do, and also the research and development cost of these products, and also the type testing cost of these products. The cost is something that is anticipated. I would not be able to share the exact number. However, because of this cost coming in, and after developing a first 400 765 kV class product, we would be able to say how much margin improvement that comes into play. As of today, With that margin improvement and cost coming in, setting up the margins, we would like to share that the margins for coming times would be fairly stable in nature.
Understood. And sir, lastly, this order book that you have, what is the general execution timelines? Is it like within a year that you execute these orders?
Normally speaking, sir, 220 kV class and below, the timelines are close to 12 months to 18 months. The current order book, only a very small portion is 400 kV class. That also falls in due for deliveries perhaps starting December till March. Mostly about 80-85% of this order book will get executed in the coming year itself. Whatever orders that we'll be booking for higher kV class in this particular year will fall for execution in the next financial year.
Understood. Thank you so much for answering my questions patiently, and best of luck. Thank you.
Thank you, sir. Thank you.
Thank you. We will take the next question from the line of Sarang Joglekar from Vimana Capital. Please go ahead.
Hello. Yeah, hi. Thanks for the opportunity. So on the demand side, as you said, that a lot of capacities are coming up, but still there will be a shortfall. So just trying to understand, is there a thumb rule by which we can go? So for every gigawatt, like what amount of transformer capacity is added? Like for every gigawatt of generation capacity added, is there a thumb rule or anything like that?
Sir, very frank, this is Neeral Patel once again. So the thumb rule says it is anywhere between 8 to 11 times the gigawatt capacity gets added, the transformer capacity gets added in various kV classes. However, this is straight generation to utilization of power. Now, when we speak about grids being unstable, requirements of BESS coming in, this thumb rule generally would tend to increase because battery energy storage systems were never a thumb rule of the Indian power industry. This is again coming in just to stabilize the grid. So this is incremental requirement of transformers. There are battery storage systems getting commissioned as we speak, but generally no thumb rule is attached to it.
Understood. So it's about 8 to 10 times is what we should go by.
50, yes.
Understood. Thank you.
Thank you. We will take the next question from the line of Aditya Vora from Soham AMC. Please go ahead.
Yeah, hi, good morning, Neeral bhai. Great set of numbers and congratulations to the team. My question primarily was on the BESS. You alluded to the fact that there is no thumb rule as such, but just from an Atlanta perspective, just wanted to understand how big the BESS opportunity could be, and considering the fact that currently we are at 1.5 gigawatt hours, and by FY30 we are expected to reach any between 40 to 50 gigawatt hours. So how is that?
Sorry to interrupt in between. Aditya, your voice is breaking. Could you please repeat your question and use the answered mode?
Yeah, sorry. Is it better now?
Yes, please proceed.
Yes, sir.
Right. So my question primarily is for the BESS segment. Considering that BESS is a very large opportunity, and when you look at all the renewable companies, right from Adani Green and others, everybody is setting up massive BESS capacity. Just wanted to understand how this BESS opportunity is for Atlanta. That's the first thing. And secondly, I know you alluded to the fact that there is no mathematics in terms of per gigawatt hours how much transformer is required, but if you could quantify in numerical terms for the size of the opportunity for Atlanta and the industry for the transformer segment with respect to BESS.